Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Before we get started, I just want to thank those that served as we celebrate Remembrance Day today. Thank you to those that served. I remember meeting with my wife's Oma, who grew up in Germany, went through the World War, and the story she has is crazy, phenomenal. So thank you for those that served. I just want to say a quick thank you. What I want to talk about today is the midterm elections and are they going to save the markets here going forward? And I want to pull up a very interesting graph, and this has been brought up in all my news feed many times here over the last kind of 6 to 9 months, and we've had a really tough time in the market saying, look, it's been really bad, but hey, going forward after midterms, historically, it's been nothing but really good things for the market. And so you'll see here, going back to 1962, the 6 and 12 month period following midterm elections have always been positive. To me, that's kind of a crazy stat. There's another crazy stat that I'll bring up here where every year the Philadelphia Phillies have won the World Series. Now, I know they didn't win it, but they came close to winning it. There's been a recession to follow. So, I was kind of hoping, obviously, for no Phillies win. Sorry to any Philly fans out there. But at the end of the day, the midterms have always produced good market performance. Now, obviously, there could be a change to that going forward. That's no guarantee that we're going to have good markets going forward, because everything right now is talk about recession. Bloomberg had something out just the other day saying we're at a 100% chance. You heard that right. A 100% chance of a recession. And Mark Beavis from the Investing Academy, he did a video on that, really good video. We'll link that below on this topic. And you'll see that all the time. And in fact, when we create content, and all content creators kind of in the finance space right now on YouTube, if I do something on recessions coming, we get lots of views. If I do something on no recession, markets are great, or positive stuff, people don't watch it. And so people, I talked about this just the other day in a video, people are geared towards negative news and they start going down that rabbit hole. So I think some positive news that we have to look at as far as like data from the past is following midterm elections, markets going back to 1962 have always been positive after 6 and 12 months. I know this year heading into the election, the markets are way down. And we haven't had that in a while. You have to kind of go back quite a long ways to see that. But that doesn't mean that we're going to keep going down and going up either. But I think it's interesting facts, right? I think a lot of people, you have to look at past data to kind of come forward with what's going to happen, how markets work, economies, all this kind of stuff. And again, typically coming out of those midterms, we see good stuff. So Bloomberg says 100% recession. The midterm elections say 100% non-recession. So where do we kind of fall in between? And I think a lot of you are leaning to there's a recession coming. A small percentage says, you know what, I think we're near low and we're going to see good markets going forward. Now, what I want to do in this video is give you the toolbox. Doesn't matter which side of the coin you're on. I want to give you the toolbox to figure out how to come through this next 6 to 12 months, whether we hit a recession or markets go straight up from here. So let's first start off with those of you thinking that there's going to be a recession ahead. And I think this is like 80% of you watching this video. And if you think there's going to be a recession, leave a comment below why you think there's going to be a recession and maybe some things that you've taken, some actions that you've taken to make sure that you can weather the storm. That might help out other viewers that are in your situation as well, right? We're here to help each other. It's not just me preaching to you guys. It's the community that leaves comments, that helps each other out. That's where the value of this content and these videos lie. So if you're sitting on the side of, you know what, Adam, I think there's a recession coming. I think we're, going down, more negative territory in the stock market. I'm really concerned about my investment portfolio, my retirement portfolio, my retirement income. For those of you and a lot of you watching these videos are close to or into retirement already, you have a cash flow need. You don't have a full-time job giving you a paycheck. That paycheck is coming from your savings that you've built up over time. And now those savings are being depleted from really bad stock markets. And the fear for you sitting in this camp is things are only going to get worse. What do I do? The first thing that you need to do is look at your cash flow needs. What is the cash flow need that you need over the next 6, 12, 18 months? That's the kind of timeline I would look at. So if you have a cash flow need of, let's say, $5,000 a month, take off, any, if you're collecting CPP, OAS, any pensions, anything that's already coming in outside of your investments, take that off and what are you left with? So let's say you're left with $3,000 a month. That means over the next 12 months, you're going to need about $36,000. Now, where's that $36,000 coming from? Work backwards from here. This is how you have to kind of wrap your head around it. So, okay, for the next 12 months, I need $36,000 out of my investment accounts, out of my, let's call it RIF. Now, let's say you have a $250,000 RIF. You need to pull $36,000 out of that, which is obviously a decent percentage. Let's call it 15% of that account. Now, do you have dividends coming in? If you have dividends, let's say that's 5%. Okay, well, we're getting there. We still have another 10% that we need to pull out. Where's that coming from? Are you selling equity? Have you bought maturing bonds that are coming up? Like, what does your portfolio look like? Do you need to make adjustments to your portfolio to make sure that the cash flow is there? So again, if you have kind of growth favored stocks with no dividends and you're 100% invested, and you know you need some money out, $36,000 over the next 12 months, and you think the market is going to continue to go down, maybe you pair your loss on that $36,000 now. Maybe you sell a bit now, a bit in a month, and a bit month after that. You have to figure out a strategy that you're comfortable with. And remember, if you sit in this camp where you think the market's going to go down, and you have a cash flow need and you currently don't have that cash, you need to raise that cash. And again, if you think it's going down, you're better off then raising the cash now versus later. Again, the risk to this, if you're going to play the other side of the coin, would be, well, if you start selling out your $36,000 now because you're fearful and confident that it's going to go down, but it ends up going up, you've now lost some of the upside. You have the cash flow you need, but you've lost upside. Now remember though, here's the bright side. You need about 15% of your portfolio, 36,000 on 250. But remember, you've only touched about 15%, which means that the other 85% of your portfolio is still working for you. So if it does go the other way and starts increasing, yes, you've sold out a little bit early on that asset, but you have the cash flow and you needed that. And the rest of your asset is still working for you. And that's the majority. So that's the bright side. And that's what you have to remember. We always focus on that 15% that we sold out too early. And that's kind of where our head goes and we get frustrated with it. The 85% that you didn't sell out that's now working for you, that's what you have to remember. Now, if you think we're going to go into a long recession, more than 12 months, then get 18 months of cash flow. Figure out a plan that works for you. The plan for you versus me versus the next person, they're going to be different. But figure out a plan depends on, where your investments are, how you're invested, what your risk tolerance is. I think where people go wrong is they don't look at their cash flow need and they just sell out completely. And they don't look at the consequences of selling out. And this is my next point. If you think a recession's coming, I would highly, highly, highly review your financial plan and retirement plan before you completely sell out of the market. Because if it flips and goes the other way, we don't have the recession and things start going up 5, 10, 15%, at what point do you get back in the market? And do you need to get back in the market? Maybe you have enough money that you can just sell out, buy GICs, and live happily ever after. If that's you, maybe that's your option. But for most of you, I know it's not the option. You need your money to be working for you. So if you're fearful that it's going to go down and you completely sell out, you have to have a trigger point to get in. Either it's when it drops another 15% or goes up another 10, like whatever those metrics are. Because you have to have a point where you're getting back in on either side. If it drops 15%, that's my buy-in point. If it goes up 10 and we're starting to see a bit of a rally, I don't want to miss the whole upside. So once it goes up 10%, I'll kind of eat my cake and jump into the market then too. I think another thing that a lot of you need to look at is if you're fearful of a recession coming, that means that the stock market comes down, which means if you're invested in the stock market, it's going to come down. A lot of you are invested in the real estate market. That may also come down. But there are tools to invest where you can get a bit of a steady income. There's alternative assets. The problem with alternative assets, and these are mortgage investment corps, real estate investment trusts, stuff that pays generally a pretty good cash flow. There's some unperceived risks there, definitely. And a lot of those you're locked in for a period of time. So just be aware, if you kind of shift to that alternative asset, just be aware of what the underlying risk of that asset is. If you're locked in, what the liquidity is there and what that cash flow, and how's the cash flow treated? Is it interest, return of capital, dividends? How is that treated for you going forward? Because that could be a tax play as well. Lastly, I want to say if you're in that boat where you think a recession's coming, it's time to review your portfolio. Like, where do you stand? What do you think is going to go down? If everything goes down, where are you best protected? Again, I don't think the solution for a lot of you or any of you is to fully cash out. It's to kind of, restructure, weather the storm, make sure you have the cash flow. It may drop, but it comes back up. Just look at any long-term graph of the stock market. If you wind into a tight view, it could just be down or could just be up. But as you scroll out, you'll see it goes up over time. Obviously, there's bumps in the road, but if you can hold on And again, even in retirement, if you're pulling out 10, 15, 20% of your portfolio, you still have time for it to work for you. And most of you typically are pulling about 7 to 12% of your portfolio in retirement. That's what you should be pulling. So you're not pulling everything. You still have time for the majority of your money to work for you. Don't forget that. Now let's talk about the other side of the coin, which is, you don't think a recession is coming and you actually think could be decent markets. Like stock prices are pretty, devalued right now, especially some of these tech stocks. You look at, Meta, PayPal, Amazon, Google, Apple's down, and who knows what's coming for that. But there's a lot of good quality companies that we use on a daily basis that are really depressed and way off their 52-week high. There's a lot of upside, and I think this boat is a lot smaller than the other side, but I think there's a lot of merit to it as well. So if you're on that side of the coin, like what do you do going forward? The first thing is cash flow. Like you need to make sure you understand your cash flow. It doesn't matter what side of the coin. Know how much cash flow, know where it's going to come from, and again, play devil's advocate. What happens if the market doesn't go up and it does crash? Where's that cash flow coming from? Make sure that you're prepared for cash flow, especially in retirement. Like this matters. If you need cash flow from your portfolio, you need to build a portfolio that gives you that cash flow, that is able to weather the storm and not sell out at 52-week lows on the stocks that you own. Very important. Now, if you're sitting there saying, nothing but up from here, then if you're sitting on cash, you might want to start deploying some of that cash, right? If you think that the markets are good, again, look at cash flow. Once you know you have enough put aside, then start getting cash into the market. A lot of the people that I talk to that are sitting on, I think the market's going to go up from here, are sitting on a lot of cash because they're also the type of people that when we're at 52-week highs, they're saying stuff's overvalued, it's coming down. And so they've been hoarding up cash. So figure out if you need the cash flow from your portfolio, put that aside, and the rest of it, start working for you, right? Like figure out what that metric is. You might look at, a lot of people look at the NASDAQ or S&P 500 and say, once it hits a certain level, I'm getting money in the market. Again, figure out what works for you. If you have a professional managing your money for you, have that discussion with them to say, when does it make sense for me to get kind of both feet into the market, but still make sure I have the cash flow I need if you're at that phase of life. And the last point I'll make here is if you think the market's going up, have a strategy to get in the market. Typically just dumping your money. I'm not a big fan of this anyway, dumping all my money. So if I've been hoarding up cash over the last year, and let's say I have $10,000 I want to put in the market and get working for me, I'm the type that won't just dump 10 grand into the market. I'll probably do 25 now, another 25 in 3 or 4 weeks, and kind of lump it in every 2 to 3 weeks and dollar cost average. That way, if I'm wrong and the market dips a little bit, I'm getting it a bit cheaper. And if it goes up, well, it goes up and I'm dollar cost averaging in that way. But at least I've kind of hedged against some fluctuation. Again, no one has the crystal ball. I think that's what we have to understand is that none of us know if the market's going up or down. But what you do know is your budget, hopefully. If you don't, figure it out. How much you can save every month. Or if you're in retirement, how much you need every month. Those are the things you can control. So work with that first. From there, build out a plan and manage your expectation and your risk within your overall investment portfolio accordingly. Remember, it all drives from budget. If you don't know what you're spending, you're not going to get very far. Figure out what you're spending. From there, you can then figure out what you can save. Again, if you're in retirement, you're figuring out what your cash flow need is. And that may buffer, right? You might say, look, I love $5,000 a month, but I can live on 3. And so if we're going through a tough time in the market and you're willing to live on 3, live off of 3, take a little bit less out. My only concern and point there would be, don't let that happen for too long, especially early in retirement. You don't want the first 2, 3, 4, 5 years of retirement when you're younger and healthy and you can travel to kind of bite you in the butt because you held stuff too tight. Then all of a sudden you're like, okay, I'm going to start spending $5 grand a month, do the travel. You're not healthy enough to do it, and you kind of lost those years. So again, make sure you have a plan and a strategy around all of this. So will the midterm elections save us a recession? Well, again, historically it has, but that doesn't mean it's going to moving forward. But what you can do to control it is what I talked about today. If you think there's going to be a recession, plan for it. If you think there's not going to be a recession, plan for that as well. That's in your control. There's so many things in this world we can't control. We can't control what's going on in the markets, but we can control, again, that budget, the cash flow need, how much we can save. We can also control what we watch on the news. And I think a lot of us are gearing right now, and I know this because I see the statistics behind it on YouTube. We're gearing towards negative news. Try and find a few platforms in your life that can give positive, or at least the other side of the coin, so you get perspective from each side. And I think that'll kind of help you put yourself in a better place mentally and just see the other side of the coin. I think you need to do this in all aspects of life. And when markets are going through a tough time like they're right now, I think it's important not just to focus negative, but to see the other side of the coin, get professional opinion and analytics on that side of the coin to get good perspective. So hopefully that helped you out. Hopefully the midterms are kind of pointing to what we've seen historically. We have good times ahead. So thank you again for joining us in this video, and we'll see you in the next one.